If you don't have risk, you won't have return also.
How do I sit and set my goals if every 3-4 years some new fad comes in here?
Your first crore will not come from your mutual fund investment. Your first crore will come from your salary. Don't always be invested in like gold, silver, and all. The idea is at a very core level that your investment may make a lot of money, but you as an investor don't make that money. Idea is to allow computing to play a much bigger role in decision making. So it's not artificial intelligence, it's our intelligence translated to some computer language.
Help me with the structure of a multi-asset fund. What is true to label? Hey there, and welcome to Paisa Vaisa. I'm Anupam Gupta. Want to get smart with your money? We bring in top experts to show you where to invest, what financial trends to follow, and how to build lasting wealth. Ready to get smarter with your money? Hit that subscribe button for Paisa Vaisa and check out our episodes. Folks, welcome to Paisa Vaisa. I'm yours, Anupam Gupta, and on today's episode, I've got my most favoriteest of all favorite, and I'll tell you why, because he's come on this podcast so many times over the last. We're going to be hitting 9 years, and this guy, I'm proud to call him my friend. All of you all know him as Deepak Shenoy of Capitalmind, the one and only. It's become a mutual fund now. And Deepak, I've never had you as a mutual fund guy, but of course, Deepak, welcome to Paisa Paisa. Thank you so much for doing this for our audience.
Thank you, Anupam, and I hope I will live up to your handle and I will be with you 50 times. So,
Oh my God, the old Twitter days and the old Twitter days. So, folks, you can go back and look at the entire. We've done, I don't know, more than how many 500 plus episodes. I love Deepak for the fact that he's been a constant supporter of our podcast. I've flown to Bangalore, recorded with him twice. He's come to Bombay, recorded once, and everybody knows Deepak's journey. Really, he's now. What are you, CIO, fund manager, or what? Like I.
technically, I don't manage any money, but I pretend to. So it's the same thing.
Imagine that, huh? From blogger to CEO, I should do an entire episode on that journey. But let us start this very interesting episode of Paisa Paisa. Deepak, what's going on? Tell us about your journey of the mutual fund. What's happening? What's been happening out there? PMS now mutual fund. Just tell us about what's been happening in the last couple of weeks.
Quick run through. Okay, I'll just. So we started off as a research company. Now we were a PMS since 2017, managing about 2,000 crores, quantitatively managed and discretionary, both kinds of different strategies. Doing direct stocks for a lot of customers. We also had mutual fund portfolios for a bunch of customers. We realized that at some point, mutual fund itself makes a lot more sense because PMS has disadvantages in terms of what it can invest in, who it can serve, because less than 50 lakh you cannot serve investors at all. And thirdly, that you can't invest in all the instruments that you want to because they don't have access. PMS doesn't have access to things like international equity or certain types of debt products and so on. The last bit, of course, is the simple and perhaps very important fact that no matter what you do, mutual fund has a tax advantage over a PMS, because the minute a PMS sells and buys something else, there is a tax impact that hits the investor, whereas in a mutual fund it doesn't. Therefore, it is more useful to build long-term portfolios because of the tax simplicity that a mutual fund gives you. And a single NAV, of course, as a PMS also you have a single NAV because you care about your overall portfolio, but not many PMSs do it. We used to do it from the beginning, and we always operated on the principle that we don't want profit shares. We just want a management fee, which is typically what a mutual fund economics also looks like. So in that context, we said, okay, we should be doing this in the long term, thinking of being a mutual fund. We got licensed last year. We started our first flexi cap fund in approximately July end. So early of last year is when we actually came into going live. It's been a tough market since then. Market's up about 3%. We're up about 3%. So we're a little bit higher, but by and large, 3% is nothing to write home about. And therefore, give big gyan about performance. But I do that in the long term, there is a lot more that we can offer to the table. Basically, because we think quantitatively, think stuff that, well, I won't say AI because it's now the new buzzword and I hate buzzwords, but I think the idea is to allow computing to play a much bigger role in decision making.
Yeah.
So it's not artificial intelligence; it is our intelligence translated to some computer language. But it is something that we have always wanted to do in a large way, which is to build models that can automatically buy into stocks. And as long as you curate them on your own, you're able to kind of identify the right kind of stocks, then offer the right kind of products to different people. Equity Flexi Cap is our flagship product today. It has about 370 crores, 360 crores odd. But we also have at the same time a liquid fund, and we're launching two more funds: a multi-asset allocation fund, which makes a little more sense, because if you want to go beyond equity, then what do you do? And an arbitrage fund, which is useful for people parking for short term or and to be very tax efficient about it. So that's where we are. The
Yeah.
mutual fund, we've just started. Please do support us. Mutual funds are subject to market risks. Please all offer documents carefully. So I'll do the drill on that. But
Disclaimer.
I know that you're all aware of that as well. Yeah.
My disclaimer is that I have got an SIP in the Capital Mind Flexi Cap fund, and it started when your fund started. It is doing absolutely rubbish. So I'm going to take you and Anup to task. How dare you give me only 3% when my expectation was of 25%? Huh? And
I
25% is
know.
per year, by the way. You couldn't even give me 2% per month, Deepak Shenoy. How dare you?
Yeah.
Okay. Jokes apart. Jokes apart. Deepak, yeah, what is this multi-asset? Okay, now see, you come from an era, I come from an era where we knew Indian equities. यार अपने को पता था कि भाई चलो market चल रहा है, market नहीं चल रहा है, whatever it used to be. Everyone's focus was that. Post lockdown, you had this entire wave. Also, SIP money side flowing is now become 30,000 crores a month. What's happened in the last couple of years, man? Nothing has worked. All that buzz, that excitement is not there. What it is replaced by now is all this fancy balanced hybrid balances, balance that multi-asset. Now there's a fancy going on of international equities. Please make sense of all this for our audience, right? Because 5-10 years ago, Indian equities was the place to be. Equity sahi hai, ye sahi hai, wo sahi hai. And here we are in 2026 getting bombarded with messages, nahi yaar, multi-asset, nahi diversification, nahi ye, nahi wo. Just make sense of all of this. Ki what exactly is happening? Multi-asset diversification. Let's start from there, na?
Yeah, I think so. Mutual funds have always been a vehicle. Like, you could always participate in something using mutual funds. Now, that participate in something meant equity for the most part for retail public, right? But for the longest time, mutual funds was a vehicle to invest in debt for corporates and even for people with lots of money, because it had a tax advantage over buying a fixed deposit. Now it doesn't. But by and large, because of this tax advantage, it was a popular vehicle to invest in debt as well. Even today, I think liquid funds have 15 lakh crores in total AUM sitting in liquid funds, because it's used for short-term parking of capital. It has some advantages over short-term fixed deposits, primarily around you get better interest rates, and there's
Yeah,
no penalty for exiting too early and all that stuff. However,
correct.
having said that, I think the problem has been that we've been over-indexed on Indian equity. In the sense, Indian equity has done really well, blah, 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 blah. But the last 2 years have shown us that Indian equities don't necessarily have to be the only ones doing well. We haven't done that well. We've done maybe about 5 or 10% a year. But what has shined or done really well in the last 2 years are things that are not equity. Gold has done really well. Gold didn't do well for 10 years, suddenly it started doing well. Last 2-3 years is doing well. REITs have done 20% in the last 2 years. Fantastic returns. Then you said, okay, oh, that's interesting. What is this REIT business? Is something else? It is a real estate investment trust. It's a quasi way to own real estate using some share
Yeah.
type things that are on the stock exchange. Fine, that's great. Then you hear of InvITs, and that's also something that's interesting. Then you hear of silver, and silver is also moving like crazy. It didn't do anything for 20, 30 years, and suddenly 1 year it's up 120%. So now there's another thing. So your FOMO is building up, because you're like, why am I only in equity? Why am I only in Indian equity? All the money that's moving isn't moving in US, because moving is from the into the non-India equity means you go to the
Mhm.
US, you start looking at stocks like Google and something and something, and then you find they're doing really well. And then somebody tells you, I invested in Anthropic when it was like just a baby and it had gone up 500. You're like, dude, how many investment opportunities are there? I mean, where should my money go? And can I have like 10 lakh rupees, and how can I put all my money into all these random things that you're talking about and still make a decent return? Multi-asset came into the, like, kind of into the limelight, and we're adding one more flavor to that and saying, I'll talk about my stuff at a later point, but I'll tell you about the multi-asset as a category. The idea is at a very core level that your investment may make a lot of money, but you as an investor don't make that money. I mean to say that it is possible. For instance, I did a calculation and said, my father bought Hero Motocorp shares, Hero Honda they were called, in
I know where
1984
you're
in the
going
IPO.
with this.
Yeah,
Yeah.
in 1984 in the IPO. That stock has gone through bonus, plate, pata nahi kya kya, whatever has happened. And 10,000 rupees invested in 1984, or 1,000 rupees invested, or 10,000 rupees invested in 1984 would have probably translated to nearly 7 crores of uh, money today. It's a lot of
A lot
money.
of money.
Now, my father did invest something like that, but somewhere along the way he sold, and then somewhere along the way my mother also sold a few shares in the middle. So it ended up with a lot less than that. I can say that if you had held the money, you would have made 7 crores, but I don't have the 7 crores to show for it, right? So, in that sense, what happened was it looked like it went up too much, perhaps. My father sold a little bit. It looked like it did something else. He had put these shares as collateral against a loan he had taken. That's why he couldn't sell the rest. He sold whatever else he had in his account. He just put some of them shares as collateral. So now the same thing, if you apply to everything else of our investment, we say, oh, this is good, doing really well. Isko, let us, and Anupam, I remember once when the Nifty Next 50 was doing well, even you had mentioned the Nifty is the best thing to invest in, because in the long term it has done really well. Guess what? Even today that is true. If you have been an SIP investor in the Nifty Next 50 for 10 years, you would have made out better than the Nifty 50 itself, and probably half the mutual funds in the country also. But the problem is the last 3 years have been incredibly tough on it. Even with, guts of steel, you're probably thinking, why am I investing in the Next 50? I should invest in something else, because that something else is going up and you're not getting the return that's close to it. You're thinking you should be getting the best return, right? But a lot of people, don't have this kind of patience or time. Second, they want something that, doesn't make them feel miserable for missing out on something else. So, I mean, short of crypto and real estate and all that stuff, which anyway a mutual fund cannot do today, and things like Bitcoin and whatever, all that stuff, you can actually have a single product that invests in all of these things: equity, debt, InvIT, REIT, international equity, crude, gold, silver, zinc, commodities, everything. So then wherever there is a bull market, you probably have some exposure. And wherever there's a bear market, that's going to take you down, but something else. So you kind of smoothen out the volatility, and this allows you to stay invested, because you look at something and say, you know what, this is a product that invests in a lot of things. So therefore, you're not going to get the 20-25% per year. The 2% per month is out. Here it's more like Meko 10% per year is also good enough, because now I'm doing it across all of these things, and you give me two things: peace of mind. I can stay invested for a long term. I can continue my SIP. I can add more money without worrying too much that it will go down 30%. But more importantly, it also adds a layer of tax protection, which means that if I normally had invested in everything individually, that tax protection comes from the fact that if I invest in everything individually and equity goes up 30%, 40%, everything else is down. I am thinking that I'm over indexed on equity. I should take out money from equity, put it in something else. The minute I put money from equity, there's a taxation, 12.5% plus surcharge. You pay that much to the government, only the remaining can go. The remaining goes, then you say, oh, that has become too much. Gold and silver pagal ho gaya, silver has gone up. You sell the thing and put it back. Then the government charges you tax on whatever you sold again. Maybe it is a small tax, 12.5%, but hey, so the tax inefficiency stays. So a multi-asset single fund will basically remove that need for you to pay tax during rebalances, and therefore give this whole thing, bring it all together. It's a lovely concept, But I think,
Huh.
therefore, that is why you're getting 10,000 crores a month in multi-asset funds now.
Huh? 10,000 crores a month.
Yeah, nearly 10,000 crores a month. In fact, last month, just gold ETFs and all got 30,000 crores. But
Huh. Huh.
the multi-asset funds themselves are getting 10,000 crores a month, about as much as mainstream equity funds as well.
Okay. Help me with the structure. I'll get to something in a bit, but just help me with the structure of a multi-asset fund, right? Because I don't know whether there are any preset percentages here that SEBI or AMFI or the regulator says ki nahi, multi-asset mein you can only do this. Or is it like free for all? I can
Okay.
be like 100% or I can be just help me with the structure out here so that our audience gets an idea that when it says multi-asset, what does the label say and what is true to label?
Yeah. So, two things over here. SEBI has said that there are only three asset classes I care about. The first asset class is equity. REIT, if you want, it's also going to be called equity only. So you want to invest, you invest international equity, Indian equity, REIT, all these are equity. So equity is one asset class. Fixed income or debt is another asset class. InvIT and bonds and government securities and debentures, all of these are fixed income. So that is
Hmm.
another asset class. Third is you take all the commodities put together: gold, silver, crude oil, whatever. That is the third category. There are three asset
Okay.
classes. You have to have at least 10% in each of these asset classes at all
Ah.
points in time. That is the true to label concept. Now, some multi asset funds may say, okay, I will have 70% equity, 30%, 20% debt, 10% commodities. Perfectly fine.
Satisfied.
Fixed
Yeah.
allocation. People like us now, Capitalmind is launching a multi-asset fund. We are saying that the Capitalmind multi-asset fund will have varying degrees. That means we will dynamically increase our allocation to equity and bring it down when times change. Dynamically increase our allocation to commodities and bring it down. So we will be
Hmm.
minimum 35% in equity. It can go all the way to
Ah.
80%. We can be minimum 10% in debt. We can go all the way to 55%. We can be minimum
Okay.
10% in commodities, go all the way till 55% in commodities also. So it's like a dynamic thing. The reason is sometimes commodities are doing well, I want to buy more commodities. Sometimes debt is doing well, I want to buy more debt. Sometimes equity is doing well, I want to buy. I want minimum 35% equity because one of the tax laws says that if you have 35% or more is equities or commodities, whichever one, then the mutual fund is taxed as if it's an equity fund after 2 years of holding,
Ah,
which
I was
is
going to ask you that, but I'm
significant.
glad you said that. Yeah.
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 So
Could you
after
repeat
2 years,
that
not
one? Sorry.
after 2 years of holding. So it's not, it is a good way for you to build long term wealth, because when you exit, you don't want to be taxed so much money to tax so much on your exit that it makes it difficult for you to kind of hold.
So
So
just to
that's
repeat that, 2 years plus is long-term capital gains at 12.5%.
that's the current rule. So there is no concept of equity taxation in long term capital gains. It is either
Yeah.
you're taxed at 12.5% after 1 year, which is in a pure equity fund where you have more than 65% equity all the time. The
Yeah.
second one is if you have more than 35% equity or literally 35% non debt, you are
Yeah.
taxed at only 12.5%, but after holding for 2 years, not 1 year.
Yeah.
So
Yeah.
there is the effectively equity taxation, but after 2 years will happen if you have minimum 35 something percent something else than debt. We have
So
that
who's
by
going
having
to
at least 35% equity.
so who's going to do this headache for me? You guys will tackle it for me, na? If I invest if I invest in your firm, because I'm not going to where am I going to know what percentage in what? I mean, so you'll give me that capital gain statement. Just
Yeah, a capital gain statement plus we'll tell you that our fund is classified as after 2 years you'll be taxed as long term capital gains. So that is for
okay.
sure.
Okay.
That is our job.
Okay.
We will never violate that.
Okay. Yeah. See,
So therefore,
because now
but
I'm
the tax structure can change tomorrow if the government changes the
no,
tax
that's okay.
structure.
That's
Yeah,
unless you have some special communication with the finance minister. I don't know about that, but let's assume that.
I wish. Yeah, I mean, I hope I could say yes, but no, I don't have such things.
Okay, okay, okay. I want to come back to this whole, skepticism that I have, yeah, because 2 3 years ago, mutual fund industry said keep put in small mid cap. Then they said put in sector, put in thematic. Defense is doing good. This is doing good. That is doing good. 10 years ago, you said equity sahi hai, India sahi hai, mutual fund sahi hai, ye sahi hai, wo sahi hai. Okay, so first is this, you know, I get that mutual funds are selling their product and all sorts of things. So I started my SIP. I did all of this. Now certainly now for 3 years nothing is happening. Okay, so now you're saying, "Acha, chalo multi asset karo." But isn't that the point? That if Indian equities are not doing well for 3 years, I should be loading up on that. If I have a long term scenario, if I have a longer term, talk to us about goal planning here. I mean, how do I sit and set my goals? If every 3, 4 years some new fad comes in here, how do I
Yeah,
make sense
that's
of this, man?
absolutely true. In fact, one of the reasons why we started a multi-asset fund now is because we feel that people with over-indexed exposure to equity are missing out on the simplicity of having a single instrument to invest in everything. So when you do that, you basically remove this need for saying that, for you, you should buy equity fund, and for you should buy debt fund. And no, you know what, debt is not going to do well, so please buy equity now. Aap debt ko becho, equity ko kharido. And so you are constantly switching that role. I'm saying, why are we doing this? If you have something that says, boss, whatever's doing well, we'll buy it. We have our own internal way to keep buying these things. It will be tax efficient for you after 2 years. It will have exposure to a lot of things. It gives you slightly more peace of mind compared to just equities, by saying it is not as volatile upside and downside. Though some days you'll find some crazy times, like gold goes up 50%, silver goes up 100%, but you're participating, so you're okay. And then it may go down also 50%, but you don't lose too much because it's a small portion of the overall portfolio. So your NAV doesn't go up 10% and 20%. It goes up 1%, comes back 1%, So that way, it's a little bit lesser on that front. And then you have a product that kind of goes across the landscape, where I feel that I could sell my mother a fund like this, because she
Ah,
will be less worried about its daily ups and downs. Relatively speaking, less complicated for her to invest and to kind of track and keep. I think it's true for a lot of people. So, to that extent, I think, of course, I think mutual funds in general do a disservice by creating funds for every new fad and theme. But there are people who specifically want to invest in that. It's usually for those people that the fad and theme is created, right? So saying, no, no, your fund house, no, you should make a defense theme and we'll buy it. So they buy it. So it's created for a certain purpose. But ours is, we're saying, let's go beyond the fads and saying, forget the fads. And I'm not even saying invest in gold and silver. I'm not even saying, so I'm saying that gold and silver, you have to think beyond. You want to invest in copper. And now, where will you go to invest in copper? There are no copper funds. There are no
hmm,
copper ETFs in India. There's only one type of fund that can invest in copper, and that answer is multi-asset funds, right? So if copper
hmm,
does really
hmm.
well, there is no other way to participate other than by going to some MCX, creating an account, buying the future, rolling over the future every month, figuring out how much margin is there, and MTM payout
Yeah,
is there every month, paying 40% tax on the gains every month, regardless of whether you're
yeah, yeah,
in the
yeah,
position or out of the position. Who does this? Nobody does this. They want a
yeah,
fund that, boss, you handle it. And I don't even know if
yeah.
copper is a good investment today and tomorrow.
Hmm,
You only have to figure out. No,
hmm,
somebody else have to
hmm,
figure this out. So I'm saying that to get rid of this join every fad territory, have a fund that
hmm,
can invest in anything, and whatever is the new performing thing, you might have an allocation to it. So you
hmm.
reduce the need for people to invest in fads rather than increase the
Ah.
fad, footprint.
So tell me about, talking from an investor behavior, investor profile, goal planning, whatever it is perspective, from the investor perspective, who are multi assets for and who are they not for?
Okay, so who are they for? Think of long-term goal planning thought processes. I'll okay. Let me give you an example. My younger son is in the eighth standard. About 4.5 years later, he will have to go abroad or somewhere for studying. I don't know where he wants to go, so I'm going to at least plan for the most expensive thing, which is abroad. In India,
Mm,
so there's one thing. So my question then is, what do I invest in? If I invest in equity after 3 years, I'll be 2 years left to the goal. I'll be thinking equity is too risky. Don't want to invest. So after 3 years, I have to then take the money out and put it into debt or a hybrid or arbitrage. It doesn't give me that much return. So I'll want to put it into a hybrid, and then as soon as it becomes that, I'll have to do this and all that. So the goal planning layer can simply involve, buy me a hybrid fund when I'm about 5 years away from the goal or about 4 years away from
yeah,
the goal.
yeah,
I
yeah,
should just buy
yeah.
a hybrid fund and buy it and keep it throughout,
Mm,
because his college fees don't come all in one year. I just have to take
Correct.
out maybe 25% of the money in year one. So I will build it so that I can 25% of the money will probably be in debt. So technically,
Yeah.
I'll take out the money from there, and I won't have too much of a hit on my overall, sequence of returns. And then I will
Yeah.
be able to extract the money out at that time. It won't hurt my portfolio too much, and then I'm getting a slow growing, not a great growing, not insane growing portfolio. But I
Yeah.
know that I can consistently invest in this. Goal planning with people who want the tax efficiency and a natural glide path, I
Hmm.
think that is there. Of course, you will still have equity exposure at the time you need the money, but given the time periods that this involves, you might be able to stretch that over a longer period of time.
Yeah. Yeah. Yeah.
Um,
Okay.
that is one layer. So the second person is a person for whom volatility is a fearful thing. To
Yes.
invest in
That is the most
equity,
important one.
yeah,
Yeah.
I think
Yeah.
that is
Yeah.
like, my mother doesn't care really, but if you have a person who cares about
Hmm.
volatility, they will call you every month and say 1 lakh डाला था 1 लाख से 90,000 हो गया. Then you're like, okay boss, I understand now. You don't want to. So even if you put 1 lakh in equity and 1 lakh in fixed deposit, they are not worried about the fixed deposit, they keep worrying about the equity. Even if you have
Obviously.
1 lakh in equity and 25 lakhs in fixed deposit, they are worried about the 1 lakh in fixed deposit, in
Of
equity,
course.
not in the this
In
thing.
equity. Yeah. Yeah.
Yeah.
Yeah. Yeah.
I mean,
Yeah.
even though that equity loss is like some 2% of their overall portfolio, they are more worried that it has fallen 10%. So why are we? So if you do that and say, forget all of this, we'll mix it all together, you'll see one NAV. You won't know whether equity has fallen or something else has gone up, but you see the net
Yeah.
change of everything. It may be up 2%,
Yeah.
down 2%. So it's much easier to absorb. So then you are
Chalo,
like,
okay.
okay, those are the kinds of people for whom multi-asset is what. You know who it is not for? It is not for the people
No,
who
tell
can't
me.
take any risk at all.
Okay.
Because multi-asset is risk. It doesn't mean
Yeah.
multi doesn't mean that you won't have risk.
Yeah. Yeah.
Because if you don't have risk, you won't have return also. I mean, the
Correct.
return will come down commensurately if there's no risk at all. There may be some
Yeah.
low risk items here, but it doesn't mean that overall the portfolio has no risk at all. So it means that if
Yeah.
you're
Yeah.
worried and you want like debt fund type returns, then either buy a liquid or an arbitrage fund. We have an arbitrage fund also coming up for people like this. The idea is
Yeah.
your risk covers. The arbitrage fund is a better fund to be in tax wise than a multi-asset fund. Second person it is
Okay.
also not for is a person who wants insane, like gold 60% gaya, so your fund should be doing 60%. The answer is
Okay.
no, because you
Yeah.
naturally are constrained by the overall portfolio, right? Your construction
Yeah.
cannot involve, say, more than 55% of gold. Even if I had
Yeah.
55% gold, I would be only up 30% compared to gold
Yeah.
60%.
Yeah.
Assuming everything else is kind of knock each other out in terms of returns. So I think people who want those extreme categorical returns, those are also people that it is not for. But there is a very wide swath of people for whom a fund like this makes extreme amounts of sense, even more than our flexi cap fund, because our flexi cap fund requires a 5 year thought process. Here I
Hmm.
would
Hmm.
say a 3 year or 4 year thought process will also be more viable. Anything more than 2 years
Yeah.
really.
Okay. Now, get me to the core concept here, right? Because I think I've read Anup or your team talking about how diversification works, because a group of assets that are not correlated to each other
Yes,
will give you good returns with a lower volatility. That is the core of this thought process, right? That I'm in different buckets in different percentages. Therefore, while I'm not getting that 100% of equity return that somebody promised me, I'm also not losing 50%. Okay, putting in different asset classes which are not correlated to each other reduces your volatility while not necessarily reducing your returns. Have I got that right? And
it is
just
very interesting that that is so.
explain this. Yeah,
Yeah.
go for it.
So
Go for it.
it is very interesting that it is so, because you might think that if I have reduced my volatility, then technically, if equity is down 30%, something is up 20%. So the net addition of the two has made my volatility only minus 10%, or mathematically actually minus 5%, but still. What this actually means is that you have balanced out the upside with the downside. So you can assume that if that equity is up 30%, you're also getting only plus 5 or plus 10%, right? So it's like, because the other one has balanced it out. In practice, it is very rare that this remains a consistent case. it means you consistently have the same amount of money in equity and consistently have the same amount of money in commodities.
Yeah,
But
yeah.
if you increase the money in commodities when commodities are doing well, reduce the amount in equity. But if you increase the amount in equity when equity is doing well and commodity is not doing well, then what might
Yeah.
happen is your upside on whatever is going up is greater than the downside on what is going down. So the
Hmm.
net return can be higher than just balancing them out. So it's like instead of 5 kg, 10 kg, you measure to 5 kg, they balanced. If I put
Yeah.
another 5 kg on one side, it goes down. The other side
Correct.
goes up, right? But what if I said that this 5 kg I put on one side, I put on the other side? So now this one goes up. So I'm overweight what is performing and I'm underweight what is not performing. And that
Correct.
return then therefore average return increases to slightly higher. So I'm getting lower volatility, yes, but I'm also getting higher return than if it was totally balanced. So
Yeah.
we are saying dynamically weight the portfolio into more equity when equity is doing well and more commodities when commodities are doing well to give you a slight kicker to your return.
Huh.
It's like, you're driving a cycle, it has a gear. Abhi tum your thing, I want to put certain effort. If I stay in the same gear, if I'm going up, same gear when I'm going down, I will huff and puff and puff and puff on the way up, and I will have very smooth ride on the way down. I'll have to keep using
Correct.
the brake on the way down because otherwise I'm pedaling too hard. But if you have gears, you're saying, boss, I'll go to a lower gear on the way up,
Hmm.
and or a higher gear on the way down. The difference is I might pedal more and do lesser distances, but I will actually not huff and puff. It's just a matter of different type of effort. And then on the way down, I'm getting more of this thing, so I can be more relaxed. So I'll change my gears on the way down. This reduces the amount of effort that you have to put in both directions. You come out further
Okay.
ahead because you can take a cycle for longer,
Yeah.
versus doing the first time when what happens is two hills and you're finished.
Yeah.
Because
Yeah.
the ride up has taken so much out of you that the downs doesn't compensate, and two ups is enough to take you out of the game. Whereas if you do the other stretch, you'll find that you can do 15 hills one after the other, so you have the ability to ride the distance. So I think
Yeah.
that is the core of the philosophy of a multi-asset, is saying, I want to reduce your
Hmm.
volatility so you can ride with me longer and not have to pay the taxation that otherwise takes the steam out of your wings, or the wind out of your
Yeah,
wings.
obvious question, expense ratios, because I'm sure people watching this would be like, यार इसका expense ratio बहुत होगा या whatever. What's that like?
Yeah, so the expense ratio will be, in general, hybrids are a little bit lesser, and it's a function of our AUM. Under 500 crores, my regular funds will charge, a commission which I have to pay to distributors also. So they will be higher. The direct funds will
Yeah.
charge about 0.5 to 0.6%. That's the rough range at which we will put our direct TR. Regular TR may be higher to the extent of how much you have to pay the industry. Typical industry commissions in multi-asset are between 1 and 1.5%. So we probably will end up with 1.25, 1.3% in the overall scheme of things. But as my AUM crosses 5,000 crores and 10,000 crores, the distributor commissions also come less. Even my earning goes lesser and lesser and lesser. So I use the economies of scale to reduce my earnings, and I might go down to 0.4% after 10,000 crores. Whereas,
Hmm.
but remember, my NAV returns to you are after expense ratio. If I
Yeah.
cannot
Yeah.
give you a good piece of return after expense ratio, then you will walk away from me. So I
Yeah.
cannot
Yeah.
overdo the expense ratio. So the difference between
Yeah.
the two numbers I told you, zero point 0.6 and 0.4, is 0.2%. Agar
Yeah.
if it is it if my lower end of the expense ratio is 0.4 or 0.3%. Remember, I have a bunch of costs which are not even go to me. About 10 basis
Hmm.
points goes to things like investor education fund, some fees,
Yeah.
some
Yeah. But that's
custodian.
regulatory.
That's some part of it is regulatory, some part of it is we are forced to have certain partners who charge me fees. There's an RTA,
Correct.
there's a regulatory, there's a SEBI fee, there's a audit fee, the auditors charge some money, a custodian charges some money. There is a rule that SEBI says that if a investor asks for a printed thing, I have to print it in paper and send it. So there are
Hard
some
copy.
people
Yeah. Yeah. Yeah.
whose only job is to buy one unit of every fund and ask for every
Yeah.
single communication only in paper, so that they can
Well
collect
done.
the paper and send it. I mean, they sell it in bulk. So that is their
Yeah,
job.
yeah, no, I get.
Now it
Yeah,
is my
yeah,
cost, and my cost is not my cost, it's my investor's cost, unfortunately, because if it's a printed
okay.
copy of a fund communication, I have to print it out and charge it to the fund itself. So these are costs
Yeah,
that are not borne by me, it is borne by the fund. And
yeah,
I get what is left of this expense ratio, right? So if I charge you 0.5%, I might actually be getting 0.35 only,
yeah.
which
Okay.
then means that I my out of my 0.3% or 0.6% per year, I have to make an extra 0.5 or 0.6% for you to be able to pay me this fee, happily saying, okay, at least he made this much. If it's a regular fund, I have to make an extra 1 or 2%. That
Yeah.
is, I think that is my goal. My goal is to say that you should not complain after the returns we get on the longer term.
Hmm. Hmm.
So if the
Hmm.
return
Right.
expectation here is say 10% after fees and taxes and everything, well, not taxes, but fees and transaction costs and all that, then I should be able to earn 12% without before it. So our
Yeah.
strategy, testing, and all that stuff, thought process should be to get that much in gross, be able to take out the fees from it, and then make sure that you have enough returns at the end to be able to do this.
Yeah.
I think all mutual funds have to do this, but yes, our
Yeah.
expense ratios are about 0.6 percent at the upper side on the direct plan. And maybe about 2% initially on the regular plan. It will fall down to 1.85 immediately uh, because of the new SEBI rule that is coming in.
Rules.
There's some GST
Okay.
elements that are separate out of it. That's all.
Okay. So, my only thing, Nadeep, after hearing all this is, see, if you look at the AUMs of the mutual fund industry, where they stand now, they are all stuck in places which have not been doing well. Okay. Small mid cap, there's a great amount. Somewhere there is sectoral thematic. So, sectoral thematic, small mid, all those categories which have not been doing well, there's a massive amount of equity AUM that are parked out there. Okay. So, I'm, you know, I'm just wondering, what you said makes a lot of sense to me. But hey, I'm 50 years old, 54 years old. My risk return is very different. If you've got some guy, take the median demographic of India, who's a 28-year-old guy, okay, probably unmarried, whatever. He's got a 30-year time frame. Last 5 years, all he's hearing is that equities is great, India is great, whatever is great, and last 3 years investments have not happened. I'm just worried that at a time when Indian equities are supposed to be doing well, okay, and I'll come to that because that's my favorite section. You're telling me कि यार थोड़ा volatility कम करो, returns almost same रहेगा at a time when, if equities have not been doing well, they will do well in the next 10 years. You're robbing me of making 50% per year by telling me that, listen, 12% per year is safe, you will sleep at night. अरे मेरे को रात को नहीं सोने का है मेरे को. I want 25%. So I'm just wondering that what is there for the youngest guy, someone who's starting his financial journey, who believes in the India story. So is a multi-asset? I don't know.
No,
What
no. I
what do
mean,
you think?
I'm telling you, I mean, even from the starting person, there is. But here's the thing, okay? I think people who are starting off in their career should stop thinking too much about where they're investing. Your first crore will not come from your mutual fund investments. Your first crore will come from your salary. So you focus on growing your salary, all this. I can tell you, you invest in multi-asset, you'll make money. You'll invest in this. बट क्या तुम मुश्किल से 5,000 रुपए का SIP बनाओगे उसमें इफ यू मेक 20% वर्सेस 18% द डिफरेंस इज प्रॉबली 100 rupees per year on or per month if you may on a 5,000 rupee SIP. Then what's the point? I mean, you might not look at it as a meaningful amount even after 2 years. You're looking and saying, "Acha, 1-2% extra banega, but that is equal to 2,000 rupees per year." Now, maybe it's not a huge amount, but when you have a crore sitting in the bank, then the 2% is meaningful.
Uh,
Then
yeah,
you are thinking that those numbers change. So I think for the young person, I would say just invest in anything. It doesn't even matter. You invest in us, you invest in index fund, you invest in equity, debt. It doesn't matter because the differential in returns is not meaningful in absolute terms. You're making
yeah,
your money primarily by staying in the game for the long term. And in the long term, it will make a lot of difference if the corpus is large. So while you're building your corpus, it doesn't really matter. I would love to say invest in my multi asset fund, but I think philosophies are different. If you're a person who's a return
yeah,
chaser,
yeah, yeah.
like you just said, 25% chahiye, I don't care if I sleep at night. Fine, then chase the returns. Buy the thematics, buy the buy the things that are, that possibly are an extreme. In many cases, just buy the funds that are not doing well right now, because hopefully they will do well in the future. That's perfectly fine.
Correct.
A lot of other people who's like, boss, I don't, my work is like, I work in the field, I do sales, I do marketing, or I do programming, and I don't have time to do all this stuff, monitor it, feel really good about. But so instead, what I'll do is I'll just go down the wire of saying, give me something that I can invest in, that is not, that I can trust for a long period of time. I don't mind staying invested. Now, normally I
Mm.
would have told this person, invest in an equity fund like a flexi cap fund, even our own. It's a systematic approach, it's a disciplined approach, it uses algorithms that we have built, and you can
Yeah, yeah.
stay in it for the long term. It's perfectly fine. I would do myself and I would do you a disservice if I told you this without understanding your risk appetite. If you say that your risk appetite is not too much, boss, I get worried if markets fall. Then I'll say, boss,
Mm.
look at a multi asset. No, no, even there I'll get worried. Then look at an arbitrage or look at a liquid
Correct.
fund. It
Correct.
doesn't matter.
Yeah.
So here's this thing. Then, of all the 28-year-olds in the country, where do you think the maximum investment is today? Despite all of our investments, being told that we can get fantastic returns in equity, great returns, all of that stuff, the maximum investment today is in fixed deposits. Fixed deposits
Yeah.
are the most tax inefficient of fixed income products. You get taxed on the money. Even if you don't use the interest, you have to pay tax on the interest. So you
Mm.
put 1 crore, then you're getting 8% interest by mistake, you have, or by luck, you have got an 8% FD product. You're still
Mm.
paying tax, and net of tax return is probably 5.5 or 6%. Whereas the same investment, even if it got only 7% in a in a arbitrage fund, has a much bigger
Yeah.
advantage to you, because as long as you stay invested, you're never going to pay that tax. You're going to pay the tax only when you get out.
Mm.
And that
Yeah.
tax may
Yeah.
be at a much lower rate in an arbitrage fund, only 12.5%, versus in a fixed deposit, you don't have a choice, it's just added to your income. So, to that extent, it is an inefficient tax product. It's sometimes an inefficient return product also. This 8% I talk about in FD very rarely happens. You go to some of the largest banks in the country, they're giving you 5% for a 1 year deposit, maybe 6%.
Correct.
Whereas
Yeah.
the same bank gives me as a
Mm.
mutual fund
Mm.
7%. It's called a
Yeah.
wholesale deposit, not available to you, because I am buying it in 25 crore chunks. And I have the ability to talk to them and negotiate to them. The same bank gives me 7%, it gives you 6%. You invest in my mutual fund invests in the same bank, and you get a higher return net of my fees,
Correct. Yeah. Yeah.
which is
Yeah.
quite strange that it's happening, but it is happening. And
Yeah.
therefore, I would say this is not an easy circle to draw, because
Okay.
people don't buy the most efficient products. People
Correct.
buy what they're comfortable with. They buy FDs because they're comfortable with FDs. They don't jump and buy equity funds because equity funds are promising the best return. The problem is that every time there's a downturn, they say FD is better for me, I am done. And that is when, in fact, we have not come to that situation. Even though small caps are in not so great a shape, they're still positive in a 2 or 3 year time frame. There have been
Mm.
times
Mm.
when in a 3 year time frame, small caps are negative 50%.
Yeah. Yeah. We've seen
So
that.
we've seen that. So not 50%, maybe okay, 20%. But still,
Yeah.
you've seen, once you've seen something like that, you're almost like, boss, this is not for beginners. Don't jump into it unless you know what you're talking about. And I have
Yeah.
seen, it's like crypto. Bitcoin is on 50% from the top.
Yeah.
Now, what happened
Yeah.
to all those guys who said crypto, crypto? Some of them are themselves calling, boss, this is dangerous, boss. The other people are saying, who have bought at 20,000, seen it go to 140,000, back to
100.
60,000.
Yeah.
Now they're saying, buy. If you are not buying,
Yeah.
how will it go up? Because their
Yeah.
20 has become 60. They don't want the 20 to go back to 20, so
Yeah.
at 60 to
Yeah.
go down to 20. So, at a very volatile asset class is a problem in your own head, more than it is a problem for other people. The younger you are, the less you should be worried about this. And
Yeah.
if it worries you, invest in a fixed deposit, boss. It's no problem until you
Yeah.
reach a point where you have size. That size could be 25 lakhs, 50 lakhs, whatever. It depends on you. But when you reach that size, then you choose the right kind of fund to invest.
Yeah. I think that makes sense. Okay, folks, we're going to take a small break out here. I think we're done with the multi-asset discussion part. Then in the next part, we're going to talk about everybody's favorite topic. क्या लगता है? Why the Nifty will reach 100,000 as per Deepak Shenoy? Okay, just kidding. We will be right back.
Did you know Indians report nearly 800 cases of online financial fraud every day, which has resulted in losses exceeding 1,000 crores in the last 5 years? To keep you safe from such fraud, I am starting my newest podcast series, Conversation with Vigilante, an initiative by HDFC Bank. In every episode, I will feature special guests who can share expert insights on the different types of fraud, their modus operandi, and how you can protect your money. Stay safe, stay vigilant, and don't forget to tune into Conversation with Vigilante. Catch the episodes on all audio streaming platforms and V for Vigilante YouTube channel.
And welcome back. Okay, Deepak Shenoy, now comes the क्या लगता है part. Okay, but before that, na, I have to ask. Gold हो गया, silver हो गया. I missed the entire bus. What now, yaar? What is left? I mean, this last 1 year has been all about that. I don't know what's happening. Batao.
Yeah, we saw this. We said, okay, boss, when we started a multi-asset, we are starting multi-asset at a point when gold and silver are at highs. People are worried what
Yeah.
happens. And silver fell 30% in one day. If
Yeah.
anything falls 30% in one day, I think people start throwing stones at other people, right? So now what happens if you do that with silver and all? So we said, boss, you can't just focus on one. I'll give you an example. Silver, great this year. 5 years ago, worst performing product for the year. Gold, great this year. In 2000, I think 2019, 21, it was the second worst performing product, minus 2%.
Wow.
In a year when equities
Yeah.
were up 80%. So we said, boss, first two things. Don't buy all commodities all the time. Don't always be invested in like gold, silver, and all that. Say, there are other commodities also. No, aluminum will do well, crude oil will do well, maybe zinc will do well, nickel will do well. There's some EV battery, the nickels will be part of that thing. Sometimes natural gas will do well. So if you have these energy based metals, precious metals, you shift between them as the opportunity arises. So tomorrow, if gold and silver
Okay.
are not doing well, it's fine. Take more exposure to something else that's doing well. Copper may be doing well. Copper has a 5-year super cycle. Aluminum has a 3-year super cycle. Gold has a 3-year cycle. So typically it moves in 3 years, doesn't move in 3 years and all that. So it doesn't mean you have to be invested in the same product all the time, but find the ones that are in an up cycle. They're usually different from the ones that are on a down cycle. They're uncorrelated with each other. So you get the exposure and across. So I mean, I hate to plug my multi-asset all the time, but Capitalmind is actually saying, boss, think beyond gold and silver. There are other things called commodities. There are other reasons for them to rise. We will at least have them in our universe and we'll buy them at the right points in time. So that is our slight differentiation, if you may. But the idea is keep your universe large enough, pick the right opportunities.
ओके चलो भाई क्या लगता है मार्केट 21 महीने
Yes.
में पैसा डबल मेरा
21
कराओ कैसा भी कराओ बॉस
वैसे पैसा डबल 21 महीने में see the
Where is
problem with this is I wish I could say all this, okay, but
no
there is
you
only
can't
there used to
we
be a dream 11 and now apparently there isn't. So unfortunately udhar bhi nahi hota hai, but otherwise you have to go to a casino.
there'll be people after us my
Yes.
my bichara podcast will be affected your mutual fund might be affected so
नहीं, नहीं, because I mean I
let's
think neither
just
you nor me can promise, no, in the end lottery खरीदना पड़ेगा. लगा तो लगा, जिसका लगा मैंने बोला सही हो गया. तो लेकिन
Mutual funds, no, wait. Mutual funds are subject to market risk. Please read the offer document carefully before investing. Past performance is not indicative of future performance. Deepak Shenoy, did I get that right?
yes, only one thing is not just offer, it is all scheme related documents, but yes.
With that disclaimer out of the way, please tell us, Deepak Shenoy, what's your outlook for Indian equities or I don't know, the next 1 year, or what do you think is happening?
Yeah, so I think two parts. Okay, let me just summarize. Things have been weird for the last maybe few years. Weird as in markets are up, but अपने को activity नहीं दिख रहा था ground पे. ठीक है, we were worried कि शायद प्राइस बढ़ा है तो कुछ एक्टिविटी होएगा. What will happen in the future. But it didn't happen for a while. I'll tell you what was not happening. I was very worried about bank credit growth. Credit growth had cratered at some point and it had fallen. It was going up because of these unsecured loans. RBI clamped down on unsecured loans. It was going up because of housing loans. Housing loans have come down because prices have gone up, whatever, whatever. So credit growth has not been very good, very kind for a long time now. So I said, okay, boss, credit growth nahi hai, to kuch to hoga. What else? This thing, they were saying consumption. GST, when it came, they said it will do 1 lakh crores. It took 1 year to reach 1 lakh crores. Then it was struggled to 1.2, 1.3 lakh crores. Then he said, okay, maybe it will take some time. Then you said a bunch of other things. FI started selling like crazy. 2 years consecutively they sold. Until January also they sold 35,000 crores. Okay, so that's another problem. US puts 50% tariff. So we have another problem. Not just puts 50% tariff. Trump every day is changing its mind about whether India is a friend, an enemy, or something else. So
Right.
you don't know whether that 50% is going to become 100% or come back to 0% or stick at 18%, nothing. EU is talking things, but nothing is happening and there's no deal, there's nothing on the table. So the answer to all of this was this uncertainty was sitting and building up. And because of that, I think equity returns kind of collapsed because
Hmm.
small and mid caps weren't able to take it. Our interest rates were relatively high. RBI has brought them down. So over a period of time, RBI has cut down interest rates, brought things down to a much more stable level. What has changed? क्या लगता है बाजार? अभी अभी का अभी is February 19, 2026. Markets are down
Yeah.
1.5% today. But I am telling you that there are some green shoots.
Okay.
Not just because I'm a mutual fund guy, because I put my worries out in public every month. Every month I put inflation chart, something else. कि बॉस FII बेच रहा है, RBI डॉलर को प्रोटेक्ट नहीं कर रहा है. All this drama I put. दर्द की कहानी I put online. But in this दर्द की कहानी, it is my responsibility to also say that there is very interesting green shoots. Now, what are they? Forget all this drama around India defense करेगा ये all that you leave. You forget those are
Okay. Okay.
thought processes, right? I am saying hardcore data leke aa. What is it?
Okay.
After 10 years, industrial credit growth has crossed 10%, 2 digits.
Huh.
After 10 years, 10 years we've had less than 10% per year industrial credit growth. means capex ही नहीं हो रहा है. तुम बोल रहे हो defense, you're saying something else. Where is it? Why aren't people borrowing money to put capacity? Answer is they were using their current capacity. If you
Correct.
don't build new capacity, how will new things be sold to you? So industrial capex. So now credit growth overall is up to 15% after being at 10% for a
Okay.
long time. And industrial credit growth has gone to beyond 10%. MSME credit growth is 30% plus. Even medium and large industry are growing at double digits. So you're finally seeing a bump up in industrial credit. That's a rule, the green shoot number one. Number two, we saw things like e-way bills and GST collections reach all-time highs in both January and December, I think.
Okay.
Again,
Okay.
December and January are not Diwali months. So you're
Yeah.
not you're thinking like, boss, there's nothing extraordinary about a Diwali, about a January or December. But e-way bills
December.
are
Yeah.
being at a high is a very good thing. Logistics are happening. Things are moving. Third thing is these deals that I was talking about are on the table. I am not saying they've been signed,
Okay.
but at least we know roughly what the numbers are. So you're reaching a point where that uncertainty is going away. Point number four, and importantly, earnings are coming back. We have not
Okay.
seen this for a long time. 3 years we waited. Ki earnings mein kya yaar? Single digit earning leke, how are we so high? So now this quarter, February 15th was the last day to announce the December quarter earnings. So we kind of collated all the data together. We said median earnings on mid caps is 16%.
Okay.
Earnings growth is
Yeah.
16%.
Earnings growth.
Meaning earnings growth year on year for small caps, small cap 250, median earnings 18%. Earnings growth.
It's pretty good.
And
Yeah.
12% median earnings growth on large caps. Median, not average. Average will be lower
Yeah.
because some companies that earn a lot of money, like Coal India, they don't grow
Yeah.
so much. So their earnings are
Yeah.
overweighted if you do average. But if you do median, you don't get these numbers. So
Yeah.
now you're thinking 12% is okay, 12%. But this quarter was a very peculiar quarter because of some labor law issues. Labor law changed. So a lot of companies had to take a one-time hit. because
Correct.
of
Correct.
new gratuity provisioning requirements and a few other things. Because of that provisioning requirement increase, there's been a roughly 4 to 5% hit on earnings. That means 12% is actually 16%. It's brought down to 12% because of this one time.
Yeah. Yeah. Yeah.
That
Yeah.
means your 18% is actually 20% plus.
Yeah.
That is
Yeah.
a
So
return
looking
of
good.
earnings growth, which is looking good. So I think that
Yeah.
lastly, your FIs have finally started buying a little bit. Green shoots, early to
Hmm.
say, but 19 days
Hmm.
of 18 days of February, they have bought 14,000 crores in equity.
Okay.
So I
Hmm.
think green shoots are interesting. Market kya lagta hai pata nahi, पर some economic, is happening. Enthusiasm is happening.
Yeah, chalo, theek hai. I mean, what's left there? I don't know. Within equities, anything looking good? Small, mid sectors, anything? What do you think? I think that's my
So
last
I
question.
think, yeah, I mean, I think, it's like, I'll give you an example of craziness. 18% down on IT stocks in roughly a month, I think, by and large. Why? Because Anthropic and OpenAI are going to kill them.
Yeah,
Okay,
software
that's
services
fine.
will get finished. Yeah, yeah,
Will get finished. 2 days,
yeah.
OpenAI says I'm partnering with this fellow. Claude says I'm partnering with that fellow. Both are Indian IT companies. If you are going to kill them, then why are you partnering with them, boss? I mean, at some level, that is a problem, right? So
Hmm.
maybe it is not like they're not. Maybe they're not going to kill them. Maybe they're only going to
Yeah,
hurt them a little bit. But theek hai, it is like saying at some level, because Microsoft has a better operating system, uh, TCS cannot operate because operating system is doing what TCS is supposed to do. Well, TCS find something else
yeah,
to do. No, it's a bigger operating
yeah,
system. So your
yeah.
AI will just increase your canvas. ठीक है, I may be wrong. Some of these companies may die.
Hmm.
But I think the
Hmm.
fears of them dying are overblown. The fears
Okay.
that assume that these companies will just kill over and just die after sitting with 40,000 crores in the bank is a
Hmm.
little crazy. That they will
Hmm.
act and they will do things like this. Lot of fears will come to you every day in the market.
Yeah,
When
yeah, yeah.
Brexit happened, Indian market was down 6%. Brexit, Britain was exiting the EU. I mean, we India are the original Brexit. I mean, correct.
So,
And for us, that was the biggest positive. We still
yeah,
celebrate that day in joy and happiness and fly kites. And yet you are 6% down because some Britain is exiting some EU. And you know
uh,
what? Uh, Everything's fine now, right? So it's like at that time it sounded like the world was coming apart. 6% in
yeah.
one day in India. One day return was
One
minus
day,
6%
one
on
day.
Nifty
Yeah,
on one day.
crazy.
So markets in the short term are like babies with sugar. They will overreact
Hmm.
and they will cry and they will shout. But once you sleep through it, then they will become normal. So I think
Uh,
that is our market. Our market is sick of crying. So it
yeah,
will not
yeah,
even rejoice even when green shoots come, even when FIs
yeah,
don't sell. So we'll be like that only. But after some time, earnings drive markets. Sentiment comes back and pulls the markets up.
yeah. I think that is a good note too. I kind of miss the old Deepak Shenoy blogger who would give me 5 ideas where I can make my money 10 times. Obviously, you can't do that
I
as
wish
a
I
as
could.
a fund
Yeah, as a fund, I'm
as
not
a
allowed to. But
you
yeah,
are
I
not
know. I
allowed to
could
do
have
that.
told you, for instance, buy crypto because I have no regulation on crypto, right? So, but I don't think I'll buy crypto also. Yeah, it's one of those times when
Uh,
I don't have anything to tell you in the unregulated space. In the regulated space, of course, there are lots of interesting investments. But
yeah,
I
there
much
you
as I
go.
say
Yeah,
this, huh? Sorry?
go, go, go. Sorry, complete
No,
what
no.
you're
I
saying.
mean, I was just talking to people. I said the first thing we should look forward to is where there are low promoter holdings. A lot of companies will start announcing buybacks in April onwards because the new
Mm,
tax
mm,
law, which comes from April onwards, taxes buybacks a lot lesser on non-promoters, right?
not-
So it's a very good way for companies that have low promoter stake to pay dividends. Instead of paying dividends, they'll do buybacks, and the buybacks
yeah,
will benefit the investors like you, me, and of course us also as
yeah,
a mutual
yeah,
fund. So hopefully
yeah,
that will be an opportunity that comes our way. But ane do, I think it will come, and then we can discuss it when those things happen. But I think by and large, this is one of the those times where you have to, some there are these subjects you study when you're in school and college which you hate.
Huh.
You know it's
Huh.
never going to make any difference in your life.
Okay.
But you have to study them and pass, because if you don't pass, you have to study them again. So this is one of those times when you're passing through a market phase where you have to just pass. Then after that, your good things will happen.
But in general, the green shoots are looking good. I mean, if at the margin, the forward, say 3-year, 5-year return should at least be more than the previous 3-year, 5-year return. Is what I'm saying. That should be
I
the
would
case,
say
because
that. I would say that.
if your green shoot story plays out and gathers momentum, and we actually come with economic growth that is better than what we expect, the markets have to necessarily perform. I mean, it just flows from that. So I think I want to end on that positive note, Deepak. At least broadly, you should be more positive about what's going to happen in the forward than what's happened in the past. I hope that you kind of agree with that.
Yes, yes. I think past performance is not an indicator of future results.
Oh,
Hopefully,
that. Yeah. And all the best for your fund launches, and come over to Bombay. Yeah, this online
yes, I
online
will.
thing
I will
doesn't
be
really.
there. Unfortunately, we had a timing issue, but I'll come over anyway
Oh,
when
that's
I'm
okay.
there.
Listen, we've got Benedosa for you now, man. Come on, as
Are
if as
fantastic.
if
I mean, this is, by the way,
might have to stand.
this is one of my stories. Huh? India ka
What?
brand has always been local. Davangere is this tiny little
Hmm,
place with one hospital
correct.
and one college. They make the
Having
original benne dosa. Now that
Oh,
benne dosa
okay.
has become a popular brand, it's called Davangere benne dosa in Bangalore. Okay, there are at least
Uh,
40 shops that call it Davangere benne dosa, and now they have called it benne dosa, for removed the Davangere name, and come off to Bombay also call it benne dosa. Benne just means butter. After that, you can do what you want, but they have come there. I hope we become an international brand. Yeah, this way. I mean, I think why not? I mean, Davangere will rejoice because a product
uh,
from its homeland
uh,
has taken over and gone everywhere. But it's a pretty good product for an India brand. Banao Singapore
of
में खाएंगे.
course. If you forget about equities or stocks, but you need to buy Benedosa so you can eat Benedosa, right?
Yeah. Yes,
On
at
that
least you
note,
can eat.
that is a wrap on this. As usual, lots of fun-filled episode with our very own Deepak. I call him very own because I don't think any guest has come as often as Deepak has. So, Deepak, thank you so much for your continued support for our podcast. And thank you for doing this episode with us. Thank you so much, Deepak.
Thank you so much, Anupam, and thank you again for I know we discussed this just yesterday, and I'm so happy I was able to talk to you today. So it's fantastic.
Great to have you here. And see
Thank
you
you.
soon.
See you soon.